Good morning, good evening, good afternoon, wherever you may be joining us in the world today. Thank you for joining us. My name is Laura Pamatian. I am hosting today's new KoreChain webinar series, and today we're going to be talking about digital assets in private markets. I have two incredible guests, experts in the space, thought leaders in the space, and I just want to briefly introduce them. Jeanette Spalding, who is the co-founder of TokenWise, which connects businesses to tokenization solutions. Prior to joining the blockchain industry in 2017, she was an investment strategist at BlackRock, and she served as a technology VP at the Bank of America and BNY Mellon. We also have Dr. Karan Garamella, and I'm going to share with you all of his expertise as well. He's a chief scientist and chief technology officer at KoreChain, where he advises on blockchain strategy. Previously, he held executive roles such as program CIO and director at the state of Florida, VP and chief evangelist at Software AG, and global CIO for a GE company. He is also the author of 3 books and a number of academic and trade publications. He has a PhD in AI from the University of Florida and teaches graduate courses in data analytics and blockchain at the University of South Florida. And thank you for all of that. Thank you guys for doing what you are doing in this space, and welcome. So I am really excited about today's webinar, and we're going to talk a little bit about digital assets in private markets. So maybe we jump in, or would you guys like to introduce yourselves a little bit further?
I think you did a great job, Laura. Happy to jump in.
All right, good. Let's do it. So let's just talk about digital assets. What are digital assets? You want to maybe Jeanette, you can give me an idea of what that means.
Sure. Usually when people are talking about digital assets, they mean any type of content or asset or property or currency that exists in a digital form, usually on a blockchain. So that can be things like cryptocurrencies or NFTs or security tokens or utility tokens are all examples of digital assets. And digital assets is a term that's also being more broadly adopted in order to just give people more context around the fact that everything to do with blockchain it's not just crypto when you're talking about blockchain. There are a wide variety of different kinds of assets, and many of them regulated, that can exist on a blockchain. And so that's why a lot of the times we use the term digital assets.
I love that. And thanks for making the differentiation, right? We talk about that a lot, that blockchain is really the basis for all things, right? Cryptocurrency, digital assets, NFTs, STOs. And on that note, let's talk a little bit about what types of different digital assets there are and how they're different. Like from talking about maybe NFTs versus security tokens versus digital securities. Dr. Karan, you want to start us off with that?
Oh, certainly. Janet's answer and definition of digital assets was spot on. And one of the challenges that people have is to really understand the word digital in the digital asset. They'll basically say, wait a minute, all this stuff is in an electronic record on my platform anyway. I have an account in the bank. Is that not a digital asset? Well, just because of a bunch of electrons running about doesn't make it a digital asset, right? There has to be some governance around it. There has to be some control. It has to look like a distinct asset. And from that note on digital assets, there are many, many forms of digital assets. I don't think there is necessarily a standard framework for classifying all these, digital assets. Somewhat like the Mendeleev periodic table in chemistry, right? We don't have something like that, but there are various types of digital assets. People generally started off with digital assets thinking about cryptocurrencies, right? That's been the impetus for much of this. So now you start with cryptocurrencies, and then people say, well, wait a minute, we've got smart contracts. Could we not do tokens, right? Securities tokens. And there are other types of tokens that will come out, or digital assets, if you will, representing various things. NFTs is a classic example that we will talk more about. And you also have digital assets that represent properties and titles and sale deeds and mortgages and automobiles and so on and so forth. There's a whole slew of them. And it's important for us to understand that all of these have different uses. And one of the biggest sources of confusion that I see is what is the difference between a payment instrument as a cryptocurrency versus a securities instrument, which is, the space that, we play in on the securities side. And therein lies the night and day difference.
Yeah, and I agree, and I think also utility, right? For utility, and on that note, let's talk a little bit about NFTs, like what that is, a non-fungible token. What makes it unique, and what is it used for?
Before we jump over to NFTs, though, I just want to add something to Dr. Karan's
Yes,
point
please.
in terms of categorizing what a digital asset is. And I totally agree. I think that it's really an exciting time to be in this industry because people are creating different types of digital assets as the industry evolves. And so we are going to probably see different types of assets and asset classes evolving out of the digital asset boom. And I think one thing, though, that you can kind of say sets a digital asset apart in the context of blockchain is the idea that you have smart contracts that are at the base of things. So basically, a smart contract is a piece of executable code that is deployed to a blockchain. And then that means that anyone or anything interacting with that blockchain sees that code and understands what that code means in the context of the chain. And with regards to digital assets, what you're doing when you deploy a digital asset to a blockchain is you are putting code on that blockchain that says X people, like XYZ person or number of people have ownership over this asset. And the asset can be, in digital form, it's going to be a representation of an interest in a real world asset or an interest in a digital asset or an interest in content or what have you. But the key here is that you have that smart contract with the code inside telling you who owns that digital asset and what the digital asset is and what it's tied to.
Yeah, that's a really great point. Kind of on that note, when we're talking about writing onto blockchain and transparency, is this transparent and visible on every blockchain? Public, private, permissioned. What is your take on that? Maybe Dr. Karan, if you could start.
Yeah, I do have some opinion about that one. I think it's important to, before we answer that specific question, it's also important to understand the role of regulation and the role of risk management in these various types of digital assets. So on the public blockchains, everything is supposed to be very transparent. Well, at least the transactions are supposed to be transparent. If not the actual parties, there is some level of pseudo anonymity for them, right? But everything else is pretty much open. It's out there. But that is the nature of the public blockchain. Anyone who walks into a public blockchain should expect that all of their transactions should be visible and verifiable on chain, right? So that is the censorship resistant nature of that one. And now on the security side of it, and in many financial types of applications, complete transparency to everyone is not desirable. And in many parts of the world, there are privacy laws that dictate what can be shown and what cannot be shown, what's to be protected, right? So if we play in the regulated space, it's very important for us to understand what types of chains there are, the permission chains, and not the completely open, public blockchain, so to speak. So once we understand that context, I think then people will start understanding what the differences are. And on that note, the one other thing I want to mention this is I know many of the people who come from a public blockchain space are not really friends with regulations, right? They just want this to be a very open society. Everything goes. We don't like intermediaries, kind of thing. But what happens is that a lot of the regulations are initially meant. The spirit of them is to protect the parties in various ways. Granted that some of these regulations can be onerous and sometimes they can be incomprehensible, we get that. But the ultimate goal has really to be to protect everybody. If we learn to fulfill that and make it very efficient and foolproof, the better off we'll all be, I think.
And I think on that note as well, on the note of permissioned and public blockchains, I think a theme that we're going to start seeing, because as Kiran very succinctly gave us an overview of, the fact that when you have, there are certain use cases where permission chains are the most likely answer. And there are certain use cases where you might want to use a public chain. And I think the key here is making sure that there is interoperability between public and permissioned ecosystems. So, and we're already starting to see solutions around that allow, something that existed on a permissioned blockchain to be visible or used on a public blockchain and vice versa, and different permission blockchains that can talk to each other, just like how different public blockchains can talk to each other. So I think that we are going to see more and more of that, of ecosystems of entire networks that are going to be built across different chains.
Yeah, I think that's a really important point when we're talking about the digital assets and where they're going to live and be exposed, et cetera. And I will very much look forward to a webinar specifically about that. Hopefully we can do that in the very near future. But let's get back to NFTs and let's talk a little bit about what they are and maybe how they are different from some of the other digital assets.
Sure, certainly. If I can take a quick stab at it, Janet. So NFTs, they stand for non-fungible tokens. In the early days of the public blockchains and cryptocurrencies coming up, all of those were fungible tokens, meaning $1 is just as good as any other dollar. It can be substitutable, and you wouldn't lose anything from that. And many of those shares, for example, they're all fungible entities within their class of securities, for example, right? And now we are now seeing the non-fungible nature. So all of those are fungible tokens, and now we are seeing non-fungible tokens also take off. And the idea behind all of this is that if you have a physical asset of some type, or it's an IP, intellectual property of some type, and you wanted to fractionalize that, monetize that, make it easy for people to own that. So take art as a classic example. I mean, many masterpieces out there that are way too expensive for anybody to purchase, and either you bought the whole thing or you didn't do anything else, right? But now we are seeing this whole idea that you can take one piece of art and it's physically stored, it is safe, it is in custody somewhere, right? It is a secure location. But if you issue tokens against that, then it stands for only that piece of art. It's one of a kind. Sometimes one NFT can stand for just that one whole piece, or that one NFT can stand for a fraction of that particular piece, right? Somebody can own, the left eye of Mona Lisa. Well, not necessarily in that way, but you know what I mean, right? It's just one piece of that one. So we're seeing the equivalent of something that cannot be exchanged for something else. You can't exchange this piece of art for something else in any one-to-one fungible way, so to speak. So we're seeing many nuances to this whole nature of NFTs. Janet?
Should I add anything to add?
Yeah, I mean, I think I would just add the fact that when we're talking about NFTs, it's really about, as Kiran mentioned, the fact that it represents a unique asset, and that asset can be something in addition to, I agree, art, and either whether that's digital art or physical art, but also things like digital identity. I think that that's a really interesting use case that's coming to the fore in terms of, here's my digital ID card, and it's represented as an NFT that's unique to me. And also, when we talk about real estate, and I know we're going to get into some other use cases where, we have tokenization of real estate, but even before we get to that, an NFT can represent one asset that is a house, for example. And there was just a great example of that happened recently, where a house was sold on OpenSea as an NFT. So when you're talking about the entire asset, and that is a unique asset, then that can be represented as an NFT.
In fact, it's strange you should mention that NFT, the house, right? That house, it actually happened in my backyard, right here in Florida. Yes, and the very first real estate NFT was sold here back in, I believe it was last year, 2022, I think February or sometime like that. But it was sold right here.
Amazing.
Yeah, it's really, and to your point, right? There's a couple of use cases now, right? Like there was just one recent as well. I mean, I'm very familiar with the transaction in Florida. I'm here in Florida also. We're all here in Florida, but I think there was one recently, Jeanette, like you just said, in Atlanta or in Georgia somewhere that just transferred. So really, really interesting that what's happening out there. And you kind of touched on a little bit of, with NFTs in real estate and them being more of a utility type of product potentially, or can they be securities? And if they can be securities, how are they regulated and who's doing that? Maybe we can talk a little bit about that.
Sure.
I actually, if you don't mind, I just want to also point out just to say how much innovation is happening in this space, right, in the NFT market. I just want to cover that, and then we'll jump back to this one too. So, what people are doing nowadays, artists, when they get on stage, Britney Spears or Taylor Swift or whoever, they can take a clip, a 10-second clip, or a whole song, or a piece of a whole song, or an interview somewhere on stage, and create an NFT out of that one. And you can either own the whole NFT, which it's unlikely for most of us, or a piece of it, right? And so we have things like the Top Shot, NBA Top Shot, got the fan craze, right? You got the US Open, you got the FIFA, and so there are places, they actually have this, breathtaking moments in sport. They just capture that 10 seconds to 15 seconds of action. It's a video, right? And they create an NFT out of that one. There's a commentary around it. There's all kinds of little merchandising around it, and you can own that whole thing. It's yours. This is like the old baseball cards, but it's just ramped up to a new notch. I mean, think about baseball cards, right? You lose them in a fire, you're done, you're finished, right? But NFT, that's immutably locked on, some place, right, on the blockchain. And, that's a much more secure way. And just think of the possibilities this entire thing opens up. It's unbelievable.
I totally agree with that. And I think as we see the development of metaverses, that's going to be very cool as well, because an NFT can represent, for example, if there's a world let's take the sports kind of environment that has already been mentioned. If you are a sports fan, you can have like an NFT jersey to dress your metaverse avatar, and you are the only person potentially that has that jersey. Maybe it's like a special edition or something. And so it's very important that you have that NFT that represents that unique asset. So as we move from physical into digital worlds, and we start to spend even more of our time in these digital environments, the value of NFTs, we're going to start to see how we can use them to create art, to play with art, to dress ourselves, and all of that. I think that there's a lot in terms of the creative world and the financial world that we have to discover with NFTs.
Oh, absolutely. And now that you get into this NFTs, and Laura, you were asking about how are these things going to be represented and traded? Are there securities and so on? And something would classify as a security or not, depending on certain conditions, right? I mean, I think this is a point that many people get confused about. Cryptocurrencies, for example, are not securities for the very important reason that they are bearer instruments, right? I have the cash, in my wallet, I have it, it's mine. Securities are not bearer instruments, right? If I'm walking down the road with a block of IBM share certificates, paper certificates, and I drop them and somebody makes off with them, it doesn't become their property, right? These are non-bearer instruments. So from that perspective, NFTs, if you kind of treat them as if they were bearer instruments, meaning you put them in a wallet and somebody steals your wallet, or you've lost control of your private key, you're pretty much done with it. But then if you put that in a regulatory environment with protections around it, there's custody, there's escrow, you make them into securities, then you're in a different kind of a environment, right? Where you now treat them as securities. So the question of is it a security or not depends on not only the classic Hovey test, but it's also the specific usage that you have.
And I think that distinction is so important. I've talked to a lot of people who, when they first hear of the idea of tokenizing real world assets, they are thinking of it in that term of a bearer instrument. and they are just thinking it's impossible. How could you possibly risk, a security, an investment, a house, whatever, and potentially lose it if you lose your keys, for example, if you lose the keys to your digital wallet. And it's not that at all. It's really about putting securities on blockchain rails so that you can take advantage of the transparency and the efficiencies and the greater accessibility of blockchain in order to make more inclusive and more efficient financial solutions for people and investment solutions for people. But at the same time, you still have all of the reporting requirements, as depending on what kind of security you're issuing. But whatever, basically the idea is you're going to create this structure, legal structure, independent of the technology. You have to look at the legal structure first. What kind of security are you creating? How is it being structured? Who all's involved? What are your requirements with regards to the different regulations that you have to interface with? And then once all that is in place, then you think about the tokenization aspect of it. And the tokenization aspect of it has to be in compliance with that initial part, that initial legal and regulatory piece. And so that's when you start to see different tokenization technologies that allow you to remain more compliant automatically. And that then gets into the power of blockchain to automate certain back office processes when it comes to administrating securities.
Absolutely.
Yeah, really. I mean, such great input on that. Thank you guys for all that clarification. I think, we were kind of initially talking about NFTs, and then we got into a little bit more about security tokens or tokenized securities, and those are fungible, and how if they're lost, they can be, they're tracked and replaced, and et cetera. So that is a big distinction. I think that there's several distinctions, right, when we're talking about the difference of NFTs and tokenized securities or a security token. Or many other aspects of that, right? With that said, what about like the back end of that, like on the smart contracts and how they're created and how they are building in compliance potentially, or rules, et cetera? Like, Dr. Corinne, you want to take a stab at that one?
Sure. I always tell people when I speak, my students and, at different places, that there are only two things that people need to know about smart contracts, right? Number one, they're not smart. And number two, they're not contracts. Okay. And it's an unfortunate thing. In fact, I was listening to one of the co-founders of Ethereum speak at a conference. It's somewhere on YouTube. We can see it. And that person said, it's an unfortunate moniker we gave to this whole thing called smart contracts. They're really nothing more than stored procedures. That's all they really are, right? But in the popular press, what happened is that just because on one side there's an AI revolution going on, it's taking off, right? So people took that smart piece and they started associating that with AI and machine learning and really smart stuff. And then they took the other part contract and they said, oh, finally we get to get rid of all the lawyers, right? And lawyers are tired, there's a contract. And I'm here to assure everyone that's not the case. That's not going to happen anytime soon. But the smart contracts is a great idea. The engineering behind that, the impetus behind that is absolutely fantastic. I'm a big fan of the way Ethereum chain has, promulgated that. That's really, really good. The only challenge, of course, is how to make smart contracts really smart, and then we actually make them real legal contracts, right? And so there is a legal basis for contracts based on contract law, which I won't go into now. I can speak on that for hours. But the whole idea is, how to make those contracts like real, true contracts that have elements of contract law and legality built into them, and how can they become more auditable, right? And then foolproof. And I mean, therein lies a lot of really tremendous innovation that's been going on in this space. And of course, we too do a lot of stuff in that particular area. But I just want to kind of share that, idea with you.
Such a good point. And I, off the back of that, also want to just reiterate for the seats in the back that smart contracts are not legal contracts, right? And it's such an important distinction because we did, this industry has evolved in this sort of, in a very collaborative way across the world. That means that some of the terminology that has been adopted is not quite accurate to what things actually mean. So, smart contract, agree, it's just code, right? It's not legally enforceable unless you build it, and you are working with lawyers and you build it specifically to be legally enforceable. And then there are, mechanisms in the real world whereby you can appeal to that legal enforceability. And I think we are definitely going to see a lot more around that, particularly with advancements in AI. I know that there are a lot of AI legal tools that are coming out now. And so when you think about the possibilities of marrying some of the instant creation of legal documents via AI, that could then potentially be deployed on chain and then, connected to not only like the real world infrastructure of enforcing that contract, but then also on-chain transactions, such via oracles, for example, such that if something occurs, then the monetary transaction will happen, and if there's any dispute, it will automatically be forwarded to the relevant legal jurisdiction to be disputed. Then you really start to see the power of the convergence of all of these different technologies, and the ability to, I don't think we're going to disrupt lawyers, but I wouldn't be surprised if lawyers are going to have to start seeing themselves as, for example, prompt engineers for AI and know about blockchain and know about deploying code across different chains, or at least working with the technologists to do that. That wouldn't surprise me at all.
No, absolutely. And one approach we have taken is to to base all smart contracts on a very foundational protocol that has elements of contract law already built into them. So there is a whole judicial doctrine about contract law, right? And when you build that into your base protocol, so you have a base protocol that adheres to contract law, and on top of that, we add other clauses and other smart contract code to cater to specific types of securities or specific regulations and specific types of NFTs and other digital assets. So now you start having a much more secure base. Is it going to make it like 100% foolproof and completely get rid of lawyers? I do not think so, right? And the usual example I give is you have commercial lawsuits going on all the time, civil lawsuits, right? And the agreements have been crafted by lawyers on both sides, despite which they still ended up in court debating it, right? Just imagine taking that whole thing and removing it one step further to having programmers program these things. I think not. It's going to be even more uncertain, right? But if you start with the right attitude and the basis, like you rightly pointed out, Janet, I mean, we have to work with lawyers, and they have to also to learn to work with, the technology and understand its limitations.
Actually have a question about that, Karan. When you were talking about integrating actual legal clauses into smart contracts, in the use case that you're thinking about, is there also a real world analog? Like, is there an actual contract then that also is being signed, or is in this case the code is the law if it exists in the code?
I think we are very far off from making code is the law, right? So so we have actually a flow for this of how to create this. We have seen all kinds of really complicated agreements happen especially in the security space. So the way I think about this is you always start with the legal document, and then you look at making it a Ricardian contract, right? Meaning it's searchable. And then you add clauses on top of that one. But always, I think the actual contract is going to be the real authoritative contract. Everything else is meant for productivity. So I'll give you a simple example, right? So people below 18 years of age cannot hold securities, right? And so how do you actually prove that? We prove that because when the compliance officers on the platform perform a KYC, they do check for date of birth. And at the time they check the date of birth and award the security, they make sure that the person is 18 or above, right? So is that contract legal from that one simple principle? Yes, because it can be proven. You can query the instrument and say, are you held by a legal person? Yes, because KYC was performed. And oh, behold, here is the report on the KYC with references to the original sources, right? And that's a classic example.
Really awesome explanation, guys. Thank you so much. We've talked about digital assets and kind of what they are, and we talked about the background, how they are created, what they can do, programming, compliance. Let's talk. I kind of want to get to the compliance part and regulation and jurisdictional compliance, right? Because we're talking about this potentially global ecosystem. How do we regulate these securities? Where can they trade? How can they trade? Those kinds of questions.
For this question, it really depends on the jurisdiction. I'm based in the U.S., so I think my answers tend to be pretty U.S. centric. But at least in the U.S., there is, pretty significant securities regulation when you're talking about any sort of securities token. And I think the key here is realizing that just because something is on chain or it's tokenized, it doesn't change the law and the regulation with regards to its status as a security. So whatever would have applied if that asset were off chain in the real world is also going to apply when you tokenize it. And I think when you have something that's tokenized, really what you're doing is you're just making it easier to comply with those regulations, for example, through different token standards. So there are token standards and even just implementations of smart contracts that allow you to force the token holder to hold that token for a year, for example. And that could be in compliance with a holding period that's required by regulators. And as Dr. Kiran mentioned, the fact that you need to be a certain age or you need to potentially be an accredited investor. Therefore, perhaps you had to self-declare yourself as an accredited investor. So maybe that process of KYC is checking that you have declared yourself an accredited investor, and therefore within a given tokenization ecosystem, only accredited investors can trade tokens between themselves. So that can all be programmed into the smart contract of a token. It can also be an ATS, which is an alternative trading system that is overseeing that process, or a digital transfer agent that's overseeing that process and making sure that the rules are applied. It really depends on how that token, the environment of the token, how the token was created, what smart contract requirements were embedded in that token. That's going to tell you whether or not some of these compliance aspects are going to be able to be enforced by the token itself, or if you kind of need that overseer in the form of a digital transfer agent, which if it's a security, you're going to need a digital transfer agent anyway. So they sometimes are the ones that oversee a lot of these compliance pieces.
Absolutely. And, this whole question of, regulation and compliance, it has several layers to it, right? And right, Janet, you highlighted many of those things, right? But it all starts with the jurisdiction. So what jurisdictional laws apply? That's the important part. But within the jurisdiction, there are multiple types of regulation. It can be a Reg CF or a Reg A plus or a Reg D, and so on and so on. Each of those has its own piece of regulation. But sitting on bottom below that is or compliance with things that the company actually does, the corporate actions that the company law, so to speak. What does that say about it? And then what does it say about the actual shareholder agreements or subscription agreements, right? And so, as you rightly pointed out, I mean, there's a whole question of the primary issuance and then the secondary market, and now that's a time dimension because some of the rules that actually apply on the primary issuance don't apply on the secondary ATS. Other rules kick in at that particular point, right? So this is a very complex topic, and we'd love to have more discussion on things like this in the future. But the key to all of this is to make sure that people who are raising money or issuing these types of digital assets work with lawyers who know this space extremely well, and broker dealers and secondary market operators who have the right licenses. They know what compliance actually means in this particular area. I think it's pretty critical because I think we are seeing, I mean, this day, even today, we have seen so many SEC actions come up, against crypto, right? We are seeing this left and right. And, it's all about protecting our ecosystem, our clients, our issuers, and all of us, and making sure we're really, really, really compliant as we go forward.
Yeah, I mean what I'm hearing, and I think that is really important to note is that there is a very clear infrastructure in place today around securities, right? There's very clear lines as to if this is security, is this not a security? And if we are coloring in those lines and we are adding a layer of, blockchain tokenization, all of these other important pieces of technology that makes the processes more streamlined, more efficient, more effective, easier, etc., then how can we really go wrong, right? But it all, like you're saying, like you're both saying, is that it all starts with the real world rules of compliance, and I think that that's, we really need to stay on that track.
Certainly,
Everyone.
Laura. Certainly. I mean, I don't mean just in the sense of, oh, did we comply and check the box? I think we have to get beyond that and understand the spirit of some of these regulations. If you look at them in the correct way and say, wait a minute, they are there for our own protection, right? And if you take that viewpoint, I think people will be more receptive to some of these regulations. We may not like the way they're implemented. We think they are very, onerous. Yeah, we get that. But if you get past that one and say, can we make it more efficient? Can we protect ourselves? Can you protect, somebody from losing their private key? And then what happens to all their assets, right? I think that approach will serve us better in the long run.
Yeah, I think that, like you're saying also, is that today, this is the way we need to do it today, and tomorrow it may be different if the regulation changes, right? Which it can do. So um, we are hoping that things do evolve and change, and that
Mhm.
there is better understanding in the space around the potential of security and transparency in blockchain. And once that education and that gets out there, I mean, there may be changes and we may be doing things differently in the future, but today this is the way that we need to do things, right, to stay compliant and out of trouble. Anything to
I
add,
would
Jeanette?
I would love to ask Janet one question on this one, right? Because when I look at all these things, I come from the public market space and the financial industry. I've been here there for many decades, and I used to be a trader myself. I used to trade the commodities and futures and things like that. For my own fund, I used to do that. And but there's a lot of innovation that happens in that space. We know this, the way they securitize things and they create collateralized debt securities. There's a lot of innovation that goes on. And I'm finding that I feel there's even more innovation happening in this side of the fence on the permission chains, financial instruments in the digital asset space. I won't call it the crypto, I'll call it the digital asset space. I would love to hear your views on what types of innovations you are seeing yourself, from all of your engagements.
Yeah, I think that that's spot on in terms of where a lot of the innovation is happening. And it's funny because as a result, a lot of people don't see a lot of what this innovation is that's happening. So, but a lot of it is the information is out there, but you kind of have to know what you're looking for. For example, Goldman Sachs, they are doing a lot with tokenizing of publicly traded securities. JP Morgan has their own chain. So, and they have been experimenting with this. And a lot of times, for example, they're doing things like tokenizing repo. And they're doing that because they're looking at instruments that are typically they have a lot of like back office processes associated with this, and they see blockchain as being able to eliminate a lot of the kind of like the back and forth and the reconciliation and having to wait for settlement and all of that that's associated with trading short-term instruments, for example. It can all happen much more quickly, much more easily, much more cheaply, importantly, because with these institutions, we're talking about things that are happening at such a large scale that they really see a difference in their bottom line when they're implementing these blockchain solutions that allow them to do these transactions more efficiently. And so I think with institutions, they're really looking at this from a cost savings perspective and a human hours perspective, and ultimately a quality of life. I mean, as you were saying, Kiran, you've been a trader, and as when Laura was introducing me, as you know, I've been in the same position to be the person kind of like having to reconcile trades next day to make sure like that things went properly. And it's not something that that you wake up in the morning like, yes, I'm going to go and reconcile some trades. So if the more that we can automate some of these things, I think we're going to see more efficient banking. We're going to see better quality of life for people who work in banks, and we're going to see increased accessibility, because when you bring the cost down for things that are happening in banks, if they're seeing improvements in their profit margins, that just means that they're going to be able to offer different kinds of services to a broader range of people, because all of a sudden it's not as expensive to provide different services and products to people. So I think ultimately, even though it's invisible right now to the majority of people, I think that the majority of people are going to start seeing the benefits of it when they see that they're getting more access to things, or they're seeing their life being improved by efficiencies.
Yeah, I think that's a great point, and that kind of touches on, who should participate in regulated digital assets, right? I mean, we're kind of talking about these large institutions and their adoption, but there's everyone. Everyone really can participate on some level. Do you have anything to add to that? Maybe, Dr. Crown?
Yeah, I mean, I'll take a first stab at that one. Um, because these are regulated markets, the regulation dictates who can participate and under what capacity, right? People such as broker dealers, they have to comply. They have to be FINRA registered broker dealers. ATS, secondary market operators, have to have ATS licenses. Transfer agents need to have SEC transfer agent licensing, right? Lawyers have to be correctly, be in good standing with the bar, right? They should be really qualified legal people. And one of the things that people really get confused about is, and this sort of confusion happens and came from the public markets or the public chain markets, right? Where people say, hey, if I have this Bitcoin or this cryptocurrency and I'm giving it to somebody else, is it anybody else's business but us, peer to peer? And for currencies and some utility tokens and things like that, the answer may be no, it's your business. You take care of it. That may be the right answer. But when it comes to securities, the people who validate the correctness of the transaction for securities cannot just be any old person. So if I'm an investor in a private company and I own shares and I want to transfer those shares to Janet, right? A cotton picker in Timbuktu has no business validating that, right? They have to be either parties to the transaction or they have to have some fiduciary responsibilities in this transaction. Only they can validate the business transaction and approve that and say everything looks good and you're good to go. So I think it's important to make that distinction, right? So people with regulatory licenses, people who have KYC, AML done on them, companies have their KIP done on that. I think these are important provisions to follow. Again, not just to check the box and say regulatorily we satisfied it, but it's important to understand that we shouldn't have bad actors, sanctioned people, sanctioned countries be part of your financial ecosystem.
Great. Anything to add to that, Jeanette?
No, I think that was a great summary.
Yeah, I do too. I mean, I think kind of on that note, is there anything maybe we didn't touch on, or anything else just to kind of wrap up our conversation today that we'd like to discuss?
I think there was one thing we could probably touch on, and Janet, I mean, this also, you are extremely familiar with this. It's all fractionalization, right? So you take major assets and to fractionalize them. I know this it's already prevalent on the public side. Through securities, you're sort of fractionalizing the assets of the company and everything else, and then you're selling it in the open market. Um, so I would love to kind of hear your views also on what that means in the real estate market or the NFT markets and so on.
Fractionalization in the real estate market, I think, will, kind of going back to a point that I mentioned before, open up the possibility of investing in real estate to a whole new set of investors who were never able to invest in real estate before, or it seemed like it was out of reach. So, for example, the ability to invest in a commercial real estate property, a luxury building that's actually generating profit, and then those investors can partake in some of that profit. That's something that the average person doesn't think is within their reach. But when you fractionalize it, if you take a building and divide it into a million pieces, and then each of those pieces is represented by a token, all of a sudden that investment becomes more accessible. And because of the operational efficiencies that have been gained by putting all of this on chain, it's realistic to make that available to, piece by piece in potentially $100 increments to investors on via an online platform. And I think that those are the kinds of opportunities that fractionalization is opening up, both in terms of real estate and art. The opportunity to own a Picasso, for example, is something that people would think is completely out of reach for them. Suddenly, we are seeing, auction houses getting interested in fractionalizing, whether it's Sotheby's or Christie's, and they're looking at this from the perspective of, not only are they going to be able to generate more interest in these works of art, but I don't know what their actual motives are in terms of if they have a mission of inclusion. But I think that one of the results of this naturally is going to be that more and more people get access to previously inaccessible asset classes.
I mean, forget about fractionalizing Mona Lisa's painting. I think somebody will fractionalize just her smile. That's even more valuable.
Yeah.
Jeanette, I think you make a really great point in that, opening this up, and we look at the offerings and the regulation, right? And specifically with Regulation A, being able to go to retail and offer this to the retail investor and doing that compliantly and allowing them to participate. So pairing tokenization with a Reg A offering, I think, is really ideal. I think it's something that we're really amped on, and we're talking a lot about to issuers and how that can really benefit them, their investor pool, and many other aspects of potentially their capital raise. So yeah, really great point. So I guess just kind of last is what are your feelings about digital assets? Do you think that they're gonna go away? Do you think they're here to stay? What's your perspective?
So I think the genie has been let out of the bottle. I don't know that there's any, I mean, I know there's no going back from this. There are just too many people that realize the value of putting things on chain from the perspective of transparency, efficiency, accessibility. Once you see the possibilities, and even beyond what technology is available to us today, if we look just a couple of years into the future with emerging technologies like AI and IoT, Internet of Things, where you have physical sensors that can capture data about things and attach it to tokens on chain. Once you see where we're going with both blockchain technology and other emerging technologies, you see that we are going to be living in a completely different paradigm in terms of how we invest in things, how we drive our financial futures, how we envision ways of even how the economy works. It's all going to shift dramatically in the next 5 to 10 years. And we have this concept of the fourth industrial revolution, which is what we are currently living in, where you have, to give an example, like the Industrial Revolution is when we have these like great shifts in technology, like the assembly line or the printing press, et cetera, that basically change global economies forever. We're in one of those right now, the fourth industrial revolution, which is characterized by the convergence of new technologies such as blockchain, IoT, AR, VR, virtual reality, 5G, that's going to allow IoT devices to communicate to things, including things on chain via oracles. So all of these technologies right now are coming together, and we're going to be building all of these super applications that integrate all of these different technologies. And it's going to mean we're doing things faster, cheaper, for more people, and we're going to be doing it 24/7. So I absolutely believe that digital assets are the way forward, and will be capitalizing on a lot of these other new technologies as well.
Love it. Dr. Karan, anything to add?
Janet stole my line. I was going to use the genie's out of the bottle. No, you said it wonderful. That is best. But the only thing I want to add to that is, much as we hate this happening, I know people really suffered from this, the FTX debacle and of similar types, right? It's sad that it should happen. But on the other hand, all of this has been a big wake-up call. And technology can be dangerous, right? When the genie is out of the bottle, you just don't know what to ask the genie. And if you give it the wrong command, it can destroy you, right? So now we're all learning where the loopholes are. What would it take to have all that wonderful innovation, yet be safe and secure and be protected at the same time, right? I think it's here to stay. It's never going to go away. Nothing will change that. The only choice we have is to tame it, learn to live with it, and make the best use we can of it.
I love it. I love it. Well, I had a really great conversation with y'all today. I really appreciate your knowledge and expertise and your willingness to share. And I wanted to say just thank you so much, Dr. Corinne, Jeanette. I want to thank KoreChain for allowing us this platform to share this education. And I will look forward to our next really our interesting talks that we're going to be having here soon coming up.
Certainly.
So
Thank you.
thank you again. Enjoy the rest of your days. Thanks to everyone for joining us.
Thank you for having us.